It's that time again, time for another episode showcasing some of my favorite interviews from the show. You're watching a special edition episode of The Income Generation. Hi, I'm David Scranton, and thanks for tuning in to this special edition of The Income Generation. It's great to have all of you here. You know, each week we post brand new shows on our YouTube channel featuring interviews with well-known financial commentators and authors, as well as retirement income specialists from across the country. However, occasionally we like to do an episode highlighting some of our favorite interviews over the years. For this special edition episode, we want to share some of the most popular interviews on our YouTube channel with you. These are some of the most liked interviews, the interviews that you gave the most thumbs up to on our page. And today you'll hear from New York Times bestselling author Suze Orman, IRA specialist and author Ed Slott, newsletter editor Harry Dent, and bestselling author of the Rich Dad Poor Dad series, Robert Kiyosaki. Make sure you subscribe to our YouTube channel at The Income Generation Show so that you can get new content each and every week. Let's start this episode off with one of the most liked interviews from our YouTube channel, our interview with best-selling author and television host Suze Orman. We actually interviewed her in March of 2020 to discuss her book, The Ultimate Retirement Guide for 50 Plus. In this part of my interview, Suze and I talked about many of the points that we stress frequently right here on The Income Generation. And this includes things like the slippery slope of spending down principal, as well as the practicality of an investment strategy that allows you to live off your interest and your dividends. We hope you enjoy this special edition episode of The Income Generation. What I love about your book, in The Ultimate Retirement Guide for those 50 and over, you talk about the 3% withdrawal rate. And that's important because a lot of people are still back in the 90s on the 4% and 5% withdrawal rates. And recent studies have shown, as you know, using Monte Carlo analysis, that in some cases, even a 2.7 or 2.6% withdrawal rate is what's safe. But I know your philosophy is if you can get it through interest and dividends, then yes, you can safely take a 3%
or 4%
rate.
or 5%. I really hate when people have to go into principal in order. I hate it. Because especially if you're invested in the stock market and the market tanks. Let's just go back to 2007, 2008, 2009. Let's forget even this year. If the market tanks 57%, you've already retired, and it did tank that much, and you have to take out 4% from your original principal. So you had $100,000 and you needed to take out just, let's say, $4,000 a year. And now you're at $50,000, but you still have to take out $4,000 a year. Now you're not taking out 4% anymore. Now you're going to be taking out 8%. 8% of your portfolio. Now that $50,000 has just gone down, by really? And before you know it, your money's gone.
Yeah.
And so
You cannibalize your principal.
I really love when, until you get to the point of required minimum distributions in a retirement account anyway, which is now at the age of 72, I really like when you just live off your interest and you don't touch your principal. I would love that for all of you. And if you cannot do that, and I talk about this in the book, you might want to think about getting an income annuity. I had a woman.
Yes.
Okay, 71 years of age. Her name was Judy. She had $400,000 to her name outside of a retirement account. All right. And her Social Security check was only $2,000 a month. And she wanted more money. She just wanted $2,000 more a month. We took, or I advised her, because I'm not selling it to her, to take $200,000, put it in an immediate annuity that gave her $2,100 a month every single month, along with her $2,000. So now she's at $4,100 a month, so happy. And at the same time, to invest the other $200,000 in preferred stocks and things like that, dividend stocks. And then the last 2 years when we did this, the markets went up significantly. Her $200,000 went up a lot.
Which is great.
Right. Then we took what she gained and we let's say it went from 200,000 to 250. We took the $50,000, left the 200,000. We took the $50,000. She paid capital gains tax on it, but she's not in that high of an income tax bracket anyway. And we bought her another annuity, but now because she's 2 or 3 years older, from $50,000, she's now getting an additional like $800 or whatever it is a month, that she's getting, or $700, and
she got a pay raise.
She got a pay raise.
And she loved you for having a pay raise. That's
right.
incredible.
But that's how you plan it, everybody. Never put all of your money in an income annuity, but that's the type of strategy that you want to work with somebody to create for yourself. And that's what I talk about in the book. The one thing when you do see an advisor, if they don't tell you right up front how much money they are making off of you, get up and walk out. Yep. If you have
100%.
to ask them, well, how do you make your money, Dave? How do you make your money?
That's right.
And if you have to ask them,
they should be more forthcoming.
It's
Absolutely.
Got to be right up front.
That's right.
Yeah.
That's right. People don't mind paying fees in most cases, providing they know about it.
They know what the fee is.
I remember the first time I hired an interior decorator and was paying a fee, and I was naive. I had no idea. And when I found out that person was also getting a commission on the chairs that I bought and the bookshelves that I bought and all that stuff,
big deal.
I was upset, right? But yet, if I had known up front, I might have been okay with it because at least I had known.
Now, if you had known up front, you would have
hired
said
a different person.
one or the other. I'll pay
right.
you a fee, but I am not going to pay
Actually,
you
you're
a
right.
fee and a commission.
You're right.
So you have to be very careful when you are out there.
Cliff Notes version. Give our income generation members the Cliff Notes version as to why variable annuities can be really troublesome.
Listen, if your money especially is in a retirement account, right, you're already in either a tax-deferred account or a tax-free account if it's a Roth retirement account. Why in the world would you put a tax-deferred investment inside of a tax-deferred account or tax-free account, number one? Number two, outside of retirement accounts. You are sold a variable annuity, which is simply an annuity. It's a contract with an insurance company. A variable annuity are mutual funds within that contract. You could go out and buy mutual funds on your own. They don't have to be in a variable annuity, but a variable annuity is sold to you under this guise. You will never get back less than what you originally put in. And you're told that and you go, oh,
that sounds good,
that
right?
sounds good. The problem is you have to die for that to be
That's
true.
Right.
And you have to pay a mortality fee, 1.3% a year, in order to get that guarantee. All right, so you put in $50,000. It's now worth $100,000, but you've never touched it. And now you die. That goes down to your beneficiaries, your kids. They take out $100,000. They pay ordinary income tax on that money. Oh, you put $50,000 into no-load mutual funds, those that don't have a commission on it, an index fund, let's just say, and it goes from $50,000 to $100,000. You die. Goes to your kids. Guess what? They get a step up in basis, not one
Zero tax.
penny of income tax. Oh, you go into a variable annuity and you want some of your money out. That it's grown and now you want to take it out. You're going to pay ordinary income tax on it. Oh, you want to close the variable annuity out. You just want out. You're going to pay a surrender charge, probably 7% within the first 7 years or 10 years, just depends on the contract. Oh, you go to take it out, you close it out. Not only are you going to pay income tax, there is a state premium tax as well, depending on the state that you live on. And I could go on and on. A regular mutual fund that invests, or an exchange traded fund that you can buy and sell at any time, no surrender fees, step up in basis for your kids. If you want to sell it, you get what? You get a capital gains tax only if you've held it for 1 year and 1 day. Are you kidding me? And the whole time you own it, it's tax deferred. Here's the bottom line. never want to invest in the stock market unless you have 10 years or longer until you need this money. If you need it in 1 year, 2 years, or 3 years, you are not somebody who belongs in the stock market.
Now it's time to welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. And Jeff is also, as you know, the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. But we also want to bring in our first guest and a good friend of the income generation, Ed Slott. Ed's an author, public speaker, and a television host. And Ed's been called the best source for IRA advice by the Wall Street Journal and America's IRA expert by Mutual Funds magazine. Ed, welcome back.
Great to be back.
So, a little bit about taxes to start off. What do you think are the biggest tax things that should concern us going into a Biden presidency?
Well, people ask me this even before the election. And when it comes to your retirement savings, don't get so focused on who's in power. You control your own tax rate. You can decide how much you pay by, for example, converting to a Roth. You can turn your rate into zero if you want, no matter who's president or what administration is in. And it doesn't matter who's in power. The math is there. Look at our deficits and debts. And at some point, the big tax bill is coming. At this point, it doesn't matter what side of the political aisle you're on. At this point, any politician that tells you, I can cut your taxes, is really just saying, I'm bad at math. Please help me. So I believe by doing things like taking advantage of today's low rates, they're the lowest rates you've ever seen in your lifetime, but I don't think they're going to stay that way for too long. So it may pay to take control of your tax rate. Don't worry about what other people are doing and who's in power. Remember, your retirement plan is a long-term plan, could be 10, 20, 30 years. Who knows what's going to be? But you can control your rate now by moving from, like I always like to say, from accounts that are forever taxed to accounts that are never taxed, to start bringing down your taxable tax-deferred IRAs and building them up tax-free in a Roth IRA. That removes the uncertainty of what future higher taxes can do to your standard of living in retirement.
And it's, like you said, politics don't matter at that point because you have taken control of it to some degree. Jeff?
That's it.
Well, Ed, those are all really valid points. And, I want to key on what you said about the rising, spiraling deficits. People are worried about it, Ed, because the Biden plan includes $10 trillion of new taxes and $3 to $4 trillion of new additional spending. And people are coming to me, our viewers, our listeners are coming to me and saying, should I be concerned? Are they going to go after my 401k? Are they going to ruin the tax status of those types of things? And so help me help them and give them some more comments on what you think they should not be concerned about in that regard, which is basically just elaborative on what you said.
And will the increase in taxes crush the economy, right?
First of all, they're not going to get that much. People are overly hyping this thing. They're not going to get the big plays, the big increases everybody's talking about. Now, at this point, nobody knows what the Senate's going to be and all of that. But even so, we're very, it's split almost 50-50. Not a lot of big things, I don't think, are going to get through. But if there are tax increases, everything I just said about taking control of your rates by doing, for example, a Roth conversion, remember, when tax rates go up, anything tax-free becomes immediately more valuable. For example, look at your Roth IRA as maybe a stock. The minute they raise rates, your stock has just gone way up immediately because you have more spending power. So I wouldn't focus on that except to tell you that any future tax increases will make Roth conversions that you do now way more valuable long term.
I think getting back to what the viewers and the listeners want to hear is, everybody that's in the income generation should really be focused on converting a portion of their IRA to a Roth. Wouldn't you concur with that? Wouldn't you give that kind of input?
But you know what? You have to look at your own tax brackets. We're the lowest of all time. Maybe the best plan is to stay on a plan of doing a series of annual smaller conversions over time. So you bring down the growing debt in your IRA and bring up more you have available tax-free, because tax-free is going to be at a premium if rates go up. And I'm afraid at some point, as you just said, they will, especially on high earners.
What do you think?
Yeah, excellent point. Go ahead,
What do you
Dave.
think? What do you think, Ed, about what's been known as the rich man's IRA? People who basically overfund a life insurance policy and try to turn it into essentially a Roth IRA. If designed optimally, is that a strategy you ever see as being beneficial for people?
I don't know. Yeah. I don't know if I would call it the rich man's IRA, but but it definitely can be done. I have that in my books. I talk about a life insurance strategy that I named the life insurance replacement plan. Again, same idea as the Roth, taking down the IRA. To me, that debt in the IRA, the taxes that will have to be paid, not if, but when, is a growing debt. It pays to take them down. The foundational principle of all good tax planning is to always pay taxes at the lowest rates. Get that balance down now and build it up with cash value permanent life insurance, where you can have the same benefits as a Roth IRA, but obviously it has the big windfall to beneficiaries if you don't need it during your lifetime.
Yeah, you've got to, and it's got to be designed properly, because if it's not designed properly, it's not going to make a very good investment in the truest sense. But I've seen them, so when they are designed properly, where people who are above the limits where they can't even contribute to a Roth IRA with new money, they can do something like this.
Well, not only that, it's a much better replacement for what used to be the stretch IRA, which was eliminated last year just about this time by the Secure Act.
Yeah, I love it. Ed, thanks so much for being back with us. Thanks. We love it. Now it's time to bring in our good friend and a great friend of the income generation, author and business owner Robert Kiyosaki, founder of Rich Global LLC and the Rich Dad Company. He's also the author of the best-selling personal finance book, Rich Dad, Poor Dad. Robert, welcome back to the income generation.
Well, thank you. I appreciate what you guys do, so thank you.
And we appreciate your input. So, let's start with the 800-pound gorilla. What are your general comments about the election results?
Well, this was more than an election. This was a turning of America from capitalism to socialism to possibly Marxism. So this was a very big turn. This was not, it's no longer macroeconomics, it's psychoeconomics now. And so last night was the Marine Corps birthday. I went to Vietnam twice as a pilot. And it was like a morning. We have a 4-star there. We have 2 full bird colonels. And I was a little lieutenant, but we fought for freedom.
Sure.
And my concern is we've lost our freedom. This is
so
more
it sounds
we lost our freedoms.
It sounds by your tone as though you're not all that optimistic that the president's court cases will be successful.
Well, that's a great question, because it has nothing to do with the president. It has to do with social media. I mean, social media out of Silicon Valley with Zuckerberg and Dorsey and the Bezos, those guys run the economy now. I mean, what happened to freedom of the press? Yeah. So even if Trump wins and it gets back out there, they're just going to attack him more. So last night, like I said, with my Marine Corps birthday, November 10th, is we don't fight for Republicans or Democrats. We fight for the Constitution of America. And this Biden win we're going socialist, and radical left socialism. And that's what I'm concerned about. And it comes out of Silicon Valley, as you guys know. You guys are the last holdouts. I shall pray for you tonight.
and policy-wise, if the Senate doesn't stay red, then we can find ourselves moving rapidly towards socialism, which is a real concern. So since we're talking about socialism, obviously that starts with tax rates, which is the topic of our show today, as you well know, and taxation in general. So what are your biggest fears tax-wise under a Biden presidency?
Well, just remember, 1773 was the Boston Tea Party. America was founded as a tax-free nation. And my tax plans are the same. I'm going to make a lot of money. I'm not going to pay any taxes. And I've been doing that for most of my life. And that's why President Trump, he got nailed by the New York Times. They nailed him saying, he paid only $750 in income tax. Well, the reason he paid only $750 in income tax is because he turns in his presidential salary. He doesn't need a salary. I don't pay income tax either because I don't have any income. You know, there's three types of income: passive, portfolio, and ordinary. Ordinary income pays the highest taxes. So
Sure.
what that means is for all those people who are doctors, lawyers, accountants, you know, the high paid academic types, your tax rates are going to go up. But for the real capitalists, we're not going to pay any more taxes legally. 1773, Boston Tea Party.
I hope you're right that taxes are still friendly for business owners. And I know in your book, Cash Flow Quadrant, you talked all about some of the tax advantages. It's part of the topic of the book, some of your tax advantages for business owners. But the real issue then is what it does for individuals. And so let's say an individual that's a high income earner or a medium, moderate income earner, that's just taking a salary then, what do you think is likely to happen to that person?
Well, that's what I'm saying. It's going to be psychoeconomics. You know, this radical left thereafter. You know, I call it Robin Hood economics. You know, take from those who produce and put it in your pocket. That's what they're going to do.
Mm-hmm.
So as I was saying to you, is I'm a fan of Ayn Rand, her book Atlas Shrugged, and in that book, 1957, Anne said the capitalists or the producers will go into hiding. Well, this is where I'm hiding today. I'm on a little island in South Carolina, and my money is outside this country. So, and I do everything legally. You know, I have no plans on going to jail and things like
Sure.
that. But the tax laws are written for the smart, for those with financial education.
Capitalists do have a tax advantage in this country. I've got that. But really capitalists of smaller businesses, you know, think about corporate America. You know, what happens, what I'm worried about, for example, is what happens to the stock market when corporate taxes go from 21, you know, back up to 35. You know, we got this Trump bump because they were lowered from 35 to 21. These big companies, and it doesn't take a lot of corporate profit, by the way, to get up in that top bracket. So is it just for small or medium-sized capitalists, but not for publicly traded companies? And if so, does that worry you even more about our stock market than you were worried when we had you on the show just a few weeks ago?
Right. The difference is, you know, President Trump and I are really good friends. His sons and I are better friends. And we're real estate guys. And if you understand tax law, like I said, there's three types of income. There's ordinary income, portfolio income, and passive income. We don't pay taxes because I don't have ordinary income. I don't have a paycheck. Mm-hmm. And then I don't go for capital gains, which is, you know, the stock market. So by going from passive income out of real estate, we pay zero taxes. I'm not recommending what we do because you've got to be fairly sophisticated. But if you go back in history, 1971, when Nixon took the dollar off the gold standard, the US dollar became debt. And the only way they could collect on the debt was via taxes. So real estate guys have a massive advantage over people in the stock market because we don't pay capital gains tax either. So let's say I make $1 million on a piece of property, I can do a 1031 tax deferred exchange into a bigger piece of property and pay no taxes again. But if I make $1 million in the stock market, I have to pay capital gains taxes. So there's
been some rumors. There have been some rumors under a Biden administration that they might eliminate the 1031 exchange, though. Now you start to cut into the bone of capitalism, don't you?
No, but there's still other. If you can't outsmart Biden and Kamala, you're not very smart.
Wow, I don't even know what to say after that. That is it's too bad we're not ending the segment with that particular comment. That would be a great finish. So okay, the average individual that, like you said, isn't going to be a real estate person, maybe doesn't want to complicate their life. They're not entrepreneurial. They're just going to work. They're going to put money in a 401k. They're going to save and invest. You know, what are the best things that they should be considering from a tax perspective? Do you have any advice for the masses to try to help them even a little bit?
I really, I'll pray for you tonight because, like I said, we're going from macroeconomics to psychoeconomics. We're going to Robin Hood economics, which is take from those who produce. And if you don't make any changes, the next few years will be horrifying years. I hate to say that, but I've been, the reason I wrote Rich Dad, Poor Dad 25 years ago was as a warning. This was coming. Marx warned us, Orwell warned us, Huxley warned us, Khrushchev warned us. We're going communist. I hate to say that. Throughout history, that has always happened. And this election, like President Biden, it's really President Kamala. That's the person. And if you don't see it coming and I'm just going to do the same thing, then all I can do is pray for you tonight, because they're coming after you. They're coming after anybody who works, who produces, who is actually a productive citizen. And that's where Ayn Rand's book, Atlas Shrugged, is crucial for people to understand. This was not an ordinary election. This was a change of America. And so that's why I always appreciate coming on your program, because when I'm on CNN, they yank me. What we've lost is our freedom. Silicon Valley, Bezos, Zuckerberg, and Dorsey, I've been yanked off of my platform so many times because I just tell people what I know. And it's the subject of our show today. It's taxes.
So do you think
taxes, you'll understand capitalism.
Taxes are the tool to begin socialism, of course. But do you think that President Biden, if he becomes President Biden, President Biden will actually stick to raising taxes on those that only make more than $400,000 a year, or do you think he's gonna cut below that? We've got just 60 seconds left.
I don't really know, but like I say, it's President Kamala. Biden is dead man walking right now. I mean, it's radical left. If you can understand that we're going radical left, and if you can understand, this is why the Marines last night at the Marine Corps birthday, we were in mourning. Marines didn't fight for Republicans or Democrats. Marines fought for the Constitution of America. And the First Amendment, our right for freedom of speech, freedom of assembly, and freedom of religion was taken away. Next, they're going after the Second Amendment, which is our guns. So I'm just trying to say, it's not Republican or Democrat. You can be a Democrat, you can be a Republican. But what Marines fought for was the Constitution of America. And it's getting crushed right now. And that's why I'm saying this was not an ordinary election. It's AOC and all those other commies out there.
Maybe you and I should host a little online prayer group, praying that at least the Senate stays red and there's some checks and balances. It seems like at this point that's the best shot that we have. We need to leave it there for now, Robert. Thank you so much for being back on the show with us. Time always flies and we're having fun. We also want to bring in our first guest, a good friend of the income generation, Harry Dent. He's the author of 0 Hour and the editor of Economy and Markets, a free newsletter available at harrydent.com. Harry, thanks so much for being back with us on the show, and Happy New Year.
Yeah, glad to be here, David.
So, okay, I know you were thinking there'd be a pretty good pullback in the markets, maybe as much as 40% or more, even in 2020. And I was concerned also for a good part of 2020, but it seems like the market's trying to make a liar out of both of us. So what do you see moving forward now in 2021 regarding the markets?
Well, it's just politics as usual, where, especially transitioning here from presidents and everything, everybody wants to keep the economy up and looking good. Trump wanted that $2,000 stimulus check to make sure it didn't fall apart just as he's leaving office, which he gets blamed more for. And of course, Biden wants as strong as possible. But again, the markets are getting stretched. And what I've seen really quick, David, ever since the first bubble peak in early January 2018, every correction has gone deeper and every new high has gone higher. And this is the last new high I see. And the next correction on the S&P would be about 44%. We're at almost 3,800 recently, and I'm projecting 2,100 by the middle part of next year, June, and perhaps as early April.
What do you think's going to be the next actual trigger, though, that causes that?
Well, we just kind of saw it a little bit this morning. ADP comes out, payrolls are less than we thought. Yeah. People don't get that this economy's been stretched and stretched and stretched. And we've had the greatest stimulus ever in the last year. I mean, 3.6 trillion. in monetary stimulus in about a year since the repo crisis, and now $3 trillion and rising in fiscal stimulus. This is 35% of GDP that's just been given to the economy. Of course, they're replacing a short-term depression, and you can't keep doing this. I mean, the deficit's $3 trillion plus this year, going to be $4 trillion easily this year, and you can't keep doing this. It costs so much. So I say, what happens here, the economy keeps weakening despite the stimulus. It's pushing on a string after a point. You can only get people to refinance their homes at lower rates so many times. You can only pump up them to spend more when they don't need much and their kids have left and that. So I think the economy keeps weakening into February, March, the first quarter. And then the stock markets, which is so highly valued, and real estate finally said, well, wait a minute, it doesn't really seem to matter. We just saw the biggest stimulus program by far in history, and we're already weakening again. And that's what I've been saying. It takes escalating stimulus exponentially more to get less and less, diminishing returns, well-known concept in any addiction or growth process.
Our viewers and listeners are they're retired or near retirement. So when we get this big stock market drop that you're looking for, how long do you think it'll take before things come back? In other words, how long will the market be underwater? They need to know that.
Yeah, it's classic. This is like the 29 to 32 crash. The 90-year cycle is the most important cycle. Nobody sees it because it's so long. This is 29 to 32 happening all over again. Stocks are going to go way down, so you wait and you buy them when they're down. I am projecting and have all the way back to late 1980s, projecting the bottom of our lifetimes in stocks would occur at the end of 2022. So that's about 2 years from now, okay? Because there's a lot of cycles that play into that. But once you peak, like we did, started to crash in February of 2020, the Great Depression stock crash took 34 months from top to bottom, almost 3 years. So that would be from February of 2020 into late 2020 to December 2022 would be my best time. That's when you look for a bottom. And I've got a target on the Dow. It's scary, 5,000. When you see 5,000 and or December 2022, that's when you look to buy stocks again. Until then, get in the safest AAA corporate bonds and the 10 and 30-year treasury, particularly the 30-year. Because and you're going to not just get tiny interest, you're going to make money. It's the only thing that goes down when real estate, commodities, and stocks, all other financial assets, including gold at some point, will go down in this sort of reset. You got to remember, this is an unprecedented bubble, only once in a lifetime, every 80 to 90 years, and there is no safe investment other than really safe investments. So you have to protect your money first, and by being in those safe bonds, the appreciation on those bonds is going to give you far more income than the measly 1.7% on that 30-year treasury.
Yeah, well, of course, when you have the 30, you're right, the 30-year is the one that's going to appreciate the most when interest rates go down. So, Harry, it's been our pleasure. It's great to get your views as usual. And thanks so much for being back with us here on The Income Generation. Thanks again for watching the special edition episode of The Income Generation. I hope you've enjoyed seeing some of the most popular interviews from our YouTube channel. Make sure you subscribe to the Income Generation Show for new content each and every week. And as always, if you're close to or you're in retirement and you're concerned about your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.